Let's talk about something that comes up a lot. Does it make sense to buy down your mortgage rate? If you've ever shopped for a mortgage, you've probably heard that question. But what does it actually mean? In a previous video, we discussed how mortgage rates are determined, and we mentioned that the rates you see advertised usually have some amount of points baked in. Today, let's dig deeper into what points are and how to decide whether it makes sense for you to pay them. First, when someone says buying down your rate, they're talking about paying points up front at closing in order to get a lower interest rate on the mortgage. What is a point, you ask? A point is just 1% of your loan amount. So on a $400,000 loan, a point is $4,000. The question then becomes, is it worth it to pay points? Let's run through some examples. These numbers are for illustrative purposes only and are not a rate quote. We'll stick with a $400,000 loan and a 30-year mortgage. Let's say the rate without paying any points, often referred to as the par rate, is 7%. Your monthly payment would be $2,661. Let's say for the cost of a point, you could get a rate of 6.75. Now your monthly payment is $2,594. You are saving $67 a month, but it cost you $4,000 to get there. Now we take the cost we had to spend for the lower rate and divide it by the amount we are saving each month in payment, and we find out how long it will take before our savings matches what we spent. We find that in this example, it will take 59.7 months, which is close to 5 years, to break even. But is that really break even? We should also factor in opportunity costs, because during those 5 years, that $4,000 could have been in an interest-bearing account earning you money. So how do you decide? At this point, if you aren't even going to keep the house for 5 years, the decision's easy. Save your $4,000. If you do plan to keep it, then consider this. If you think rates will drop, you may have an opportunity to refinance later anyway. If you think rates will rise, locking in that lower rate now could pay off in the long term. Also remember, when you refinance later, you'll likely have more equity thanks to home appreciation and loan amortization. Points can work the other way too. Let's say you're less worried about monthly payment and more sensitive about funds to close. You could go with a higher 7.25 rate and get a lender credit of a point. Now your payment is $2,729, but you have $4,000 to offset your other closing costs. This can often be a great strategy during a refinance. You'll often hear a no-cost refinance advertised, but most of the time, they just mean no out-of-pocket costs because they are paying for the refinance from your equity by adding it to the loan balance. However, if a rate that comes with a lender credit is lower than the rate that you currently have, then you may be able to actually offset the costs involved with the refinance. Like most financial matters, when the question is asked if it makes sense to buy down a mortgage rate, the answer is it depends. You can't properly answer that without looking at your overall financial picture, how that mortgage fits into it, and a little bit of playing the odds and researching what the market might do in the future. You can see by this chart how much mortgage rates change over time. Looking backwards, it made a lot of sense for people to buy down their rates in 2020, but even then, only if they were going to keep the house for longer than their break-even period. The real power is running the numbers based on your goals, and that's exactly what I help my clients do. No guessing, no pressure, just clarity. If you want help running your numbers, let's talk. I'll help you compare the options and pick the strategy that makes the most sense for you.